friends, welcome to Nirmal Bang. I am Piyush Jain, and you're watching this special conversation as a part of our budget series. Today, we are bringing to you a voice from out of India, a renowned emerging market specialist, Mr. Geoffrey Dennis, an independent emerging markets commentator. Mr. Dennis actually has served for a long time in UBS and is very well known for his expertise over emerging markets. Uh, Mr. Dennis, welcome to the show.
Thank you.
And it has been interesting times over the last 12 months. We have seen in the second half of the calendar year last year, we have seen how much correction happened in the Asian markets. We saw a bit of outperformance from India versus other Asian emerging markets. And now basically we have seen over the last 1 or 2 months there has been some lagging of the Indian markets versus other Asian markets who are largely more beaten down. So firstly, let me start this conversation from the perspective of how you're looking at the emerging markets at present.
I'm very constructive about the emerging markets in 2023. And the reason for that is that it looks to me like the Fed is very nearly finished with its tightening. We think they're probably going to raise rates maybe twice more, two times 25 basis points. And I think that I've argued for some time that as soon as it became clear that the Fed was near the end, as inflation comes down, and the inflation story is obviously a very important part of that, I expected there to be a renewed interest in risky assets, including emerging markets. And the key part of that story was going to be bond yields coming down, which obviously they're doing and have done quite sharply by about 100 basis points from their peak in terms of 10-year bond yields. But also, which is very important for emerging markets, a falling dollar. The dollar's fallen pretty sharply from its peak in something like August, I think it was, and I think it'll go further. I don't think it'll go a lot further, but I think it's going to go further in 2023. So you're going to see, as I say, the Fed at the top of the interest rate cycle before too long. Risky assets doing well. Emerging markets have underperformed obviously badly last year, and indeed for the last few years. And so I think we'll do well this year. EM is already up 8.5% for the year. Now, you put India into this context, it's slightly tougher because India, as you rightly said, was a good outperformer in a very bad year for EM last year, and it has lagged very badly this year. Yeah, India is down about 3% in dollars so far this year. I think part of that's got to do directly with the recovery in China, the reopening of China, and I think increasingly investors are rightly or wrongly are starting to look at India versus China, and China's had a bit of a run here because of the end of zero COVID and the assumed opening up of the Chinese economy. But I think the fundamentals in India are very good. This is the best growth story in the world, certainly the best growth story in the emerging markets, and certainly a better growth story now than I think is India than is China. I'm sorry, and inflation has gone up, but it's not gone up anything like as much as it has in other countries. So I don't think there's any need for more interest rate increases in India. We may even see interest rates come down. And although valuations are high, so there's been some profit taking, I think the market stabilizes before too long and you start to see India doing well again.
Okay, I think our viewers will actually take some positivity about India, as you were just saying. Let's build on it further. Did you actually get a chance to sort of go through the union budget, or what were your sort of, I would say, did you like the union budget? And if you like the union budget, how basically it was supporting the thesis of an overall Indian market bullishness?
Yeah. I did like the Indian budget. I remember thinking about it and talking about it beforehand and thinking it was quite a narrow path for the finance minister to sort of run, to put in some growth expansionary measures at the same time as trying to get the budget deficit further down. And I think what she managed to do with this budget is actually put some good growth measures in. It was a very pro-business, pro-growth budget with the tax cuts, with the increase in capital expenditure, etc. And at the same time, I think probably quite realistically, because of the strength of the economy, therefore the rise in GDP, a realistic assessment that the budget deficit can drop from 6.4% in the fiscal year just finishing finishing in March, and to something below 6%, 5.9% in fiscal 24. Now, if you look at, and perhaps we'll talk about it, but I think we have to leave aside the problems at the moment of the Adani Group, which obviously are overseeing a lot of what's going on in India. But if you consider India's high valuations, its good performance, I believe that achieving a further drop in the budget deficit back below 6% next year as the target is sort of a minimum requirement, I think, for foreign investors to want to come back into the market. The rupee's been weak, but it's not been any more weak than a lot of other emerging market currencies. It's stopped going down since the dollar has started to fall. And if you were to see a tightening of fiscal policy, even though you've got growth measures being implemented, tightening of fiscal policy in the sense of a lower budget deficit, that's the sort of thing that will bring some of the FII money back into India. And therefore, I think executing that budget, including, of course, all the disinvestment plans they've got, will be very, very important. But I think the groundwork has been laid here on the fiscal side in the union budget for India, once again, I think, to do quite well in calendar 23.
Yes, and while I was listening to you, I was just thinking, if I was a FI sitting in USA or Europe, anywhere, and if I was looking at India market, and I was thinking of putting the money back in India and thinking this is a good budget, looking like a good sort of market. Another thought which my research team or execution team would be thinking, is it a good time to put the money? Is the dollar now actually not going to bounce back? Is the dollar going to soften? Are we going to actually not get some currency hits? What's your opinion? Because the money is now coming back thick and fast into Asia. Is the conclusion already done in USA? The dollar is not going to strengthen, and we actually now can go ahead with full steam into emerging markets?
I believe so, yes. I mean, I think to a certain extent, we have to see the start of this year as being, as I said earlier, a return to people wanting to invest in China. China's done so badly for 2 years. Chinese technology's had a very nice recovery, and there's good reasons for that. The regulatory pressure on Chinese tech seems to be subsiding. They're putting steps in place to try to solve the property market problem in the long term, also to boost the economy. But I think there are still issues in China. We'll see how successful the switch from the zero COVID policy towards full opening will be. Will we actually get a much, much bigger spread of COVID across China? And so I tend to think that this little spurt we're having in China will eventually, if not peter out, it'll certainly slow down. And that's the point at which I think that India will start to attract some money once again. Bear in mind that I'm sure you've talked about it a lot over there, but one of the really, really big stories internationally over the last 2 or 3 weeks is the expectation that in 2023, the population of India will start to exceed the population of China. And I think that although it's got nothing directly to do with stock markets, I think it's certainly something which will improve sentiment towards India. So I am relatively bullish. Now, about the dollar itself, the dollar is still overvalued, in my opinion. And we are nearly at the end of the Fed tightening. I do think the US will either have a very mild recession or will avoid recession completely. And so that could obviously support the dollar. But I tend to think that as the Fed gets towards the end of its tightening, you will tend to see some more downward pressure on the dollar. We're down 10%, I think, from the peak roughly in terms of the dollar index, maybe another 5-10% this year. And I think that will benefit emerging markets overall. Now, whether it'll benefit the rupee as much as it might benefit the Mexican peso or the Brazilian real, it's hard to say. But the big move higher you've had so far this year in Asia, Asia's up 9.5% in dollar terms this year, I think will continue because the dollar will go further down. And I think India gradually catches up with that and starts to take part in that rally.
Right. And from that aspect, according to you, what's the story this year in emerging markets in India, especially? Is it the infrastructure? Is it the broader consumption theme because of the larger market and government is putting money into development? Like if I see the budget, I could see three or four major pointers from our Indian side, and that could be railways. A lot of money is going in. Defense, a lot of money is going in. Like a lot of defense ecosystem investment is going in. Infrastructure, roads, railways, bridges, ports connectivity. A lot of money is going there. There is a lot of money going to agriculture, which again is a large population in India, and again brings back the rural consumption. From an outside perspective, where FIs would really want to actually put money in.
Well, if you were to see a big rally, I think, and I'm not saying you'll see a big rally, I just think India will start to recover. But if you were to see a big rally, you'd see that spread over a lot of, I think, high beta sectors, even the banks, which have not necessarily been much in favor recently. But I think you've hit that out on the head there, because this extraordinary planned increase in capex in the public sector, and as that spills over into the private sector, is going to benefit things like infrastructure, things like construction. And I think those sectors will do relatively well. And I think we mustn't forget that this is still a very, very strong domestic demand growth story in the private sector. And so I would expect to see, in general, investment related stocks do well, to see consumer stocks do well as well. In other words, I think it'll be very much driven by conventional private sector domestic demand. Now, one risk I see, and I think we must keep our eye on this, is that there's a lot of talk now at the margin of the Chinese reopening, if you like, pushing up commodity prices sharply, as China goes back from whatever it was last year, 2.5%-3% growth towards 5%, which, by the way, India is going to beat. I think, as far as I can see, India is going to grow close to 7% in calendar 23. But could that reopening of China, which has been going to be a relative surprise compared to last year, could it lead to another big move higher in commodity prices, which of course would be difficult for India, particularly in things like oil? Now, I'm very doubtful about that, because I think although China does recover and does reopen, I'm not sure you're going to get 5% growth. And I'm not sure you're going to see a big move higher in the oil price either. So I think there's some commodity strength, which is already coming through. So I don't particularly see it being a sizable negative for India from the China reopening, because you start to see commodity prices coming through. And of course, India is a big importer of a lot of commodities. So that is a risk that has to be watched very carefully, because it would impact inflation. That might compromise monetary policy. But it's a risk, sure, but I'm not sure it's going to be a big factor this year.
Right, and for our viewers, the risk which Mr. Dennis is citing, look at what has been done over the last few weeks from Chinese markets opening. Crude prices have gone up almost 8 to 10%. Aluminum prices has gone up about 5%. There has been basically a rise in broadly the sort of metal prices. But as Mr. Dennis is saying, that it's all about the initial sort of sentiment here. But Mr. Dennis, coming back to one factor, and you just cited Adani Group. I'm just asking you one question over here, because I want to know how it is being read outside India. So Adani Group, a big industrial house in India. A lot of media attention has been over the last few days about our research report about basically the way market cap has fallen. How much sort of mind space it actually gets in the for FIs, and how actually they see the entire thing, the Indian markets.
I think it's getting a lot of airtime. It's getting a lot of airtime in the serious press, places like the Financial Times, for example. And certainly, it's not getting airtime in terms of the general news, but it's getting airtime in the financial news, and it's getting a lot of airtime, therefore, I'm sure, in terms of the emerging market fund managers around the world who know exactly what's going on in India. And of course, India is a very, very big market in EM now. So it is quite worrying, I think, this particular story. Now, I would argue two things. One is, I know in the end the potentially good news where the equity offering turned out not to happen and the offering was pulled. But I think there are two caveats here. Number one, we don't know to what extent others looking at this would say Hindenburg Research is right, as opposed to the Adani Group being adequately capitalized without too much debt. And so, the debate there between the two is still out there. And secondly, I think that people are going to view it as a one-off, particularly when you see a group like Reliance, which is also a big conglomerate, of course, where you've seen some, if not debt restructuring, certainly an attempt to bring debt levels down in recent years. So I think it'll be treated as a one-off. Now, it's an important one-off, but I believe as this thing starts to subside, which I assume it will, I think investors will begin to put it in the rearview mirror and will probably not have their views of India particularly impacted by that from a negative point of view. But right now, we're in the eye of the storm, and I think it is a problem for India. But I think it's almost certainly before long just going to create a buying opportunity, because I don't think this story applies to India at large. And also, I'm not sure we even know the full details of this sort of fight, if you like, between Hindenburg and the Adani Group. So I'm not too bothered about it on a 6 to 12 month view.
Okay, so that's a sort of a view again on at present the most talked about topic here. Um, from there, what is the sort of expectation on the Indian markets from your side from the earnings growth? Like, are we expecting another 15% sort of Indian growth story on the markets? Like how much it is acceptable from a foreign investors right now?
I think, I don't have my own independent estimates of what Indian EPS growth will be. And of course, it's often been disappointing, and it's often very difficult to translate, as everybody knows, GDP growth into EPS growth. But we're starting at a very good place, given how strong the economy is going to be. And I think that was a wonderful budget, as I say, for the economy and therefore potentially for the market. So I think something of the order of 10-15% is perfectly doable. I think it's important that the numbers are broadly hit because the valuations are high. But at the same time, if you see other markets running away as they're doing so far this year, that valuation gap will narrow. And so as long as there's good delivery relative to expectations of earnings numbers that are somewhere in the double digits, getting towards 15%, again, I think India will recover. Now, as I say, at the moment, EM is up 8.5%, India's down about 3%, so we're underperforming by 1,100 basis points. We may not get all of that back by any means. We may not get much of it back, but my point would be, having had a bad start to the year and now the overlay here of the Adani Group issue, I think this is a really good potential buying opportunity in India, given the global macro environment that I've been talking about for 6 months now. This is the narrative that's been playing out. Soft landing potentially in the US, inflation peaks. I don't know whether your viewers know, but the 6 month annualized inflation rate of the CPI in the US is 2%.
Yes.
Inflation really has slowed down. The core's higher, we've got to get that down. But as that works its way out, the Fed's going to stop, bonds are going to rally more, equities are going to do well, the dollar's going to come down, and that is going to facilitate, I think, another move higher in the Indian market.
Okay, so that's something interesting here. From the perspective, I'm trying to actually borrow from your experience in the emerging markets. Usually, when actually the investors they like, and let's assume we're talking about Asia here. So, is a sort of sector story a coherent theme which runs across the sort of Asian markets in general, or the sort of a particular period? Like in India, suppose you're talking about banks and you're saying that financial theme should run strong if there is across the board rally or investment happening because banks are financing enablers. Is that something which also runs across the emerging market as the one coherent theme?
I don't think so typically. I think under certain conditions it does. So if commodity prices are booming or collapsing, you'll see generalized moves in energy and materials. That's a pretty obvious thing to say. And I think if you get something like the crackdown on a sector like you've had in China the last 2 years affecting technology at the same time as investors have been pulling money out of US tech until recently, of course, because interest rates went up so much. I think that would give you a sort of regional theme. And of course, that would be particularly the case because China, Korea, Taiwan, and obviously the States and India as well have all got sizable technology sectors. But aside from that, I think it becomes much more of a country by country analysis of which sectors will do well. As you will know, I'm sure the technology sector, because of TSMC in Taiwan, is completely dominant in Taiwan. It's nothing like
Yes.
as big in India. It's nothing like as big in Korea, where you've got a lot of deep cyclicals such as shipbuilding and steel and that sort of thing. So they're very different markets. So the obvious things to say are the sectoral patterns you'll get across Asia will be ones that involve basically global sectors such as commodities and such as in certain circumstances technology. And the banks are going to be different because although when you get a steeper yield curve, you tend to believe banks will do well because they can charge more for their loans. Banks very much, I think, are overlaid by domestic issues of past due loans, a competitive situation in the domestic system. So I don't think that's a regional sort of theme. It's very limited, I think, to the sectors I've mentioned.
Right. Again, so that's a good insight here. So in India, actually, the finance team, the banks team yesterday is the one which perhaps would be liked, and that's the sort of India-specific story. From there, actually, I want to actually move away to something which we just started talking about, technology stocks here. We also heard in the union budget, Indian government specifically taking a sort of public expenditure view, tying up with a lot of research institutions, almost similar to US. They are investing into setting up 5G labs across different engineering institutions, setting up artificial intelligence labs, also again investing into a lot of research initiatives, and that like is a very heavy expenditure. When I go back and actually I see the technology stock underperformance over the last few months here. What's your overall view from the perspective of technology sector? How FIs are viewing it?
Well, I think the issue really here, I don't know about the main issue, but a very key issue here is these are all going to generate long-term returns. They're not necessarily going to generate short-term returns, whether we're talking about AI or we're talking green energy or we're talking more conventional technology. And any of the sort of investment that's going into the sector, for example, this giant chip factory that TSMC in Taiwan is building in Arizona in the US, these take time to come to fruition. So I think that investors will be pleased to see increased investment in technology in India if that's what's happening. But I think they'll want to see the proof of the pudding, if you like. The proof of the pudding is in the eating. It's not necessarily going to be something that'll pull a lot of money in the short term, except to the extent that these these investments will boost overall growth. And if you get overall growth benefiting, you'll see that filtering down to consumer spending, etc. So I think it'll have benefits in the short term, but the actual real benefit in the build-up of the technology sector from these initiatives, I think is more likely to be long term rather than something the FIIs expect to happen today or tomorrow.
Right. And one question going out of the way from the banks here. I wanted to know like usually basically when the bond market starts performing, it also helps the bank's treasury earnings also. So are you actually looking that perhaps we have seen the worst last year for the bond market, and now where already the bonds have started rallying, you just alluded in your conversation. Is this a good year for the bond markets? Because Indian bond yields also had gone up last year. The bonds had not performed that much. And here also fund managers are talking about that this looks like a good year for the Indian bonds also. So can I correlate that with banks also? Will that basically also a sort of supporting factor?
Okay, I think it is going to be a good year for bonds, but to a certain extent, I think we've seen a good bit of the rally already. I mean, if we just look at the US for a minute, Fed is going to finish around 5.1, 5.2. US 10 years are already at 3.5, if not 3.4. Very steeply inverted yield curve. Obviously, there will be anticipation before long, and I'm not sure this is going to happen in 2023. I think it's more likely to happen next year, but eventually rates start to come down. But I think there'll be a limit eventually as to how much lower bond yields come in the US, at least over the next 12 months or so. I fully believe that eventually US inflation will go back to 2%. It just may take until 2024, the end of 24, or even into 2025. So bond yields can go lower over the long term, but I wonder how much more they'll go lower over the next 12 months or so. And of course, as you'll know, bonds have had a very good start globally to this year, corporate bonds in particular. So I think there is already a better set of conditions in play for in the bond market for financials to key off. Whether or not they do that will, I think, depend very much on this situation as perceived it to be, as is perceived to be by investors of each individual bank. But certainly, you will probably see you will now see much more favorable conditions right now for profitability in Indian banks and Indian banks generally from what's happened in the bond market. But from here on, I think it will still be driven much more by what's happening bank by bank. And frankly, I'm not following individual banks, so I can't comment on that.
Right. So again, that's an important point, important takeaway. Again, we can take from what Mr. Dennis is saying. Mr. Dennis, apart from financials, we talked about technology. Is there any other theme which traditionally you've liked in India? Any other theme?
As I say, apart from infrastructure, which we've discussed, and also to a certain extent remembering that the consumer and domestic demand is going to be strong, I think domestic related, spending sectors such as consumer, perhaps in particular consumer discretionary, are probably going to do quite well in this environment where eventually interest rates start to come down at the short end as well, and when you're going to see a nice recovery of the economy.
So that's an important point. I just want to sort of ask you again, from your experience in such an environment where either we are recovering from higher inflation or we are sort of seeing public spending, uh, what actually takes off more? Consumer staples, consumer discretionary, or both of them actually look good?
I think both of them tend to look good, but the advantage consumer discretionary tends to have over staples is that it's a higher beta sector. It tends to be something that will outperform on the upside and underperform on the downside. If the market's doing well and recovering, discretion would tend to do better. So if the economy is starting to recover, things like the auto sector or in in your case the two-wheeler sector will tend to
Yes.
do better than some of the food and retail side. But as I say, I think you're looking here now at an Indian economy that is going to grow more strongly than China in 2023. Is going to India itself is going to have a bigger population than China by the end of the year. It's currently the second biggest emerging market within the MSCI EM index. At least it was at the end of last year, and I doubt it's lost that position quite yet. And I think there'll be a lot of money coming into domestic demand stories generally once people perceive that the market's settled down. And I think that the discretionary side probably does better, but I think the consumer side generally is going to do quite well.
Okay, so these actually are the two clear themes emerging out here. Consumer discretionary being preferred over staples, but broadly both doing well. And banks is something which we've already discussed. So again, so they both actually seem to be aligning well with how the budget has been. Staples, as we know, FMCG, and especially there are a lot of, again, basically stocks from air conditioning to a lot of enablers here. As viewers, again, you've been doing it. Mr. Dennis, moving to one of my last questions here, and wanted to ask sort of there's also one narrative which was being talked last time in December here, and where actually we were discussing that if European markets which are so beaten down, USA markets were not doing well, and there was a time when actually we were actually seeing almost 15-20% sort of returns coming in the European markets from the lows. The first half of this calendar year, yes, money is coming back. We are seeing some gains, but is it actually something where FIs are also looking very strongly at developed markets, or emerging markets itself basically has enough sort of capital coming in?
I think this is a set of conditions for 2023 that would tend to favor emerging markets over developed. That's the first point I would make. But there's no doubt that I think there's going to be there's clearly evidence that global fund managers based in the US are starting to put money to work overseas. And that doesn't just include emerging markets, it certainly does include Europe. And Europe, of course, as you will know, Europe is being able to avoid a major natural gas crunch, energy crunch
Yes.
in this winter because the weather's been so mild. And therefore, the outlook for the economies is not as bad as people thought it would be. The IMF admitted that the other day as it was in the fall, in the autumn, although that's true for the US as well. But Europe's been out of favor for so long that I think, there will be a lot of attention paid to Europe as well. And that's happening. Europe's had a good start to the year also. Now, the best piece of news for the US, I think, to do well would be to see those Nasdaq-related stocks, those technology names, continue to do well. Now, they're suffering right now overnight because of earnings disappointments of various big companies, but they'll be a driver, there's no doubt, in 2023 within my overall scenario. But if I were to rank them for 2023, I'd say the EM will do best, probably followed by Europe, probably followed by the US, if only because in this global environment that we've got, and as I've laid it out, weaker dollar is an important part of that. I think you've seen so much outperformance by the US over these other two parts of the asset class for some time now that I think these are good conditions for Europe and EM to improve and to outperform.
I want to close this conversation with one question which I cannot avoid asking you, and that is the Russia-Ukraine war, which almost grabbed the headlines every month last year because of the risk involved in investing into any region last year. Is that something which is now going down from the perspective of risk management this year? Like, where are we right now from the FI point of view, from a sort of risk allocation point of view, and also from most importantly, mind space occupation point of view?
I have no idea, and I mean that genuinely. Clearly, it's dropped down the list of things on people's radar screens, but it's still there. The war's been going on for nearly a year now, and it's a very frightening situation, and it could clearly get worse through, pulling in other members of NATO, through, heaven forbid, some sort of chemical weapons or nuclear attack of some sort. But I think while this stalemate goes on, if you like, on the war front between Russia and Ukraine, and while the weather we're getting in Europe is not particularly generating any sort of energy crunch, and while Ukraine can get a lot of its grain overseas, which is such an important part of the global supply of food, I think it's going to continue to be in the background. But I'm no geopolitical expert, except I can see that resolving this is going to be incredibly difficult. Everyone knows that. Ukraine wants territory back, Russia doesn't want to give territory up, etc. It'll be very hard to do it. So I think you have to view it as a key risk for 2023, a risk that day by day people are probably going to ignore, but it's always going to be there. And I think it is got to be just viewed as a major risk to markets taking the year as a whole. But it doesn't stop me being bullish because I think the overall environment is constructive. But my goodness, we have to keep an eye on what's going on there with Ukraine, without any question.
Mr. Dennis, lovely talking to you, always getting all the insights from you. And also, thanks a lot for your patience in answering all our questions.
Thank you very much.
Dear viewers, so these are the following takeaways from our conversation with Mr. Dennis. He really likes financials. The union budget also basically was good from his perspective. Also, basically, we actually heard that there is a bit of liking on consumption also, consumer staples, consumer discretionary. I'll give examples again what consumer discretionary could imply, automobiles, also from the perspective of everything which is again basically is into equipment space, into the residential homes. And then staples also basically you can talk about everything from mutual to all the consumption companies. Banks again basically largely private banks is what FIs normally love. So again that is something as a theme which is emerging out. India is going to outperform. That's the conclusion from our discussion. And with that, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.